Welcome back. Let's take a look at futures indicating a pretty good rally at the start of trading this morning. The Dow Industrials right now up 144 and the Nasdaq's up 157. S&P higher by 33. Interest rates, meanwhile, looking like this. The 10-year Treasury yield this morning is trading lower by 1.5 basis points, sitting at a level of 4.61%. Of course, the Federal Reserve leaving interest rates unchanged yesterday for the sixth straight meeting, acknowledging, however, a, quote, lack of progress in getting inflation back down to the central bank's 2% target. Here's Fed Chair Jay Powell trying to put to rest any talk of a possible rate hike this year instead. Watch.
We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. It is likely that gaining such greater confidence will take longer. I think it's unlikely that the next policy rate move will be a hike. We'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time.
Joining me now is former Federal Reserve Board nominee, Independent Institute senior fellow, and the author of Money Meltdown, Restoring Order to the Global Currency System. Judy Shelton back with us. Judy, great to see you. Thanks very much for being here. Your reaction to the moves yesterday and what you believe will be the Fed's next move in terms of easing monetary policy or is holding steady?
Well, I think they definitely showed that they're more inclined to ease. That's what they would like to do. The market loved it when Chair Powell took the idea of a rate hike off the table. Now, it was kind of an illogical thing to say because, as our friend Judy Grant said on your program not long ago, given that the jobs market is holding up, but we see reaccelerating inflation, the Fed's own model would say maybe we're not being sufficiently restrictive. And so we should be considering a hike. The thing is, the Fed continues to say that they have that 2% inflation goal in mind, and Powell affirmed that and kept saying, whatever it takes, that's what we're going for. But really, by taking the rate hike off the table, I think what they're really saying is however long it takes. And so if the Fed waits through the end of the year or maybe even the next year and doesn't hike the rate, but just stays at this level for longer, it's tantamount to accepting a higher, closer to 3% target rate.
Yeah, and I felt like he was suggesting that he would do that in that soundbite just now, just by saying, you know, we would not be inclined to change our expectations or change policy until we were sure that inflation was moving in the right direction. You know, he's leaving himself open to begin something when he feels that it's moving in the right direction. So, Rebecca, jump in here because you had a point earlier that there are other options, right? The balance sheet is another option. I know you want to ask Judy about that.
Absolutely. So we know that the $7.3 trillion balance sheet, that they actually are tapering quantitative tightening, Judy. So what are your thoughts on that? Is this stimulative for the economy? Is this something that, you know, pre-election you could look at and say they're actually trying to help this administration get reelected? Because obviously that does help the economy.
Well, it was certainly a consolation prize because the message there is toward monetary easing. It's amazing when you put it in perspective. Between March 2020 and March 2022, the Fed accumulated another $5 trillion in government securities. They then said 2 years ago that, we're going to normalize. Maybe we don't have to have a $9 trillion portfolio. Well, in those 2 years since, they've reduced it by about $1.6 trillion. So at that pace, it was going to take them 3 times as long to reduce the portfolio as it took them to increase it. But now they're cutting that in half. They were going to be reducing their Treasury holdings by about $720 billion over the next 12 months. Now it's going to be $300 billion, less than half. So I think that they're sending mixed messages at best.
Yeah, and Janet Yellen seems to be, in many cases, getting political. She's going to give a speech, and we see some of the excerpts of it, and it's quite political, talking about Trump policy being, a threat to democracy. These are all the things that the Treasury Secretary is talking about. You mentioned Jim Grant, the founder of Grant's Interest Rate Observer, joined me recently on the program, and he said that he is expecting the Fed to do what it can to help Joe Biden by the election in November. Watch this.
I believe that the Fed itself regards a potential second term for Donald Trump as a clear and present danger to the country.
Mm-hmm. So that's why they'll get involved.
The Fed is politically very much aligned with the Democratic Party. I think the Fed, without even perhaps realizing it is doing something in the way of a political move, would be inclined to read the numbers in a interest rate reduction positive way, with in the back of its mind the threat of another Trump presidency.
So at some point this year before the election, do you expect a cut in rates, Judy?
Well, I think they're looking for any excuse to do that.
Yes, exactly.
And, one thing the Fed likes to say that one of the reasons they're independent, and this is on the Federal Reserve's own website, is because members of the administration or elected congresspeople are not allowed to serve on the Fed board. But look at it from the other point of view. You have Janet Yellen, who was the head of the Fed. She is now clearly one of the strongest members of the president's team and making these political arguments and attacks. And you have Lael Brainerd. She walks straight from being the vice chair of the Fed to being the top economic and political advisor to President Biden.
That's right.
So I don't think these people embrace the Democratic agenda just the minute they walked out of the door of the Fed.
Yeah.
So that bias was there.
Do you want to say anything about the yen? The yen weakening against the dollar overnight. Of course, recently we saw the Japanese yen take a huge tumble, and we're looking at the yen up 0.5% this morning.
I think it's pretty clear, although they won't admit it until the end of the month, that the Japanese Ministry of Finance has intervened twice this week. And when you look at the yen against the dollar, it has lost half of its value against the dollar since 2012. I mean, that's pretty significant. The monetary policy of the United States now is really hurting U.S. exporters and helping our trade competitors. And, President Trump actually brought this out recently on Truth Social. And he pointed out that it's a 34-year low, the value of the yen. And China also. We have no level international monetary playing field. And I think that it's very important to see these effects. It makes no sense now that the United States has to pay 4.6% on its 10-year government bond. Japan pays less than 1%. China about 2.5%. Even Italy and Spain have a lower yield on their government bonds than the United States. So something's out of kilter.
Judy, it's great to have you this morning. Thanks very much.
Thanks.
And the yen surging 2% on Wednesday. Traders expecting intervention from the Bank of Japan. We'll be right back. Welcome back. It's time now for the Word on Wall Street. Top investors watching your money. Joining me right now is the chairman and CEO of Strategis, a Baird company, Jason Trennert, back with us. Also with us here is Mark Tepper and Rebecca Walser. Great to see you, Jason. Thanks for joining the conversation.
Great to be here. Thank you.
We want to talk markets here. We got another rally underway. Markets reacting to the Fed, leaving interest rates unchanged as we expected at the April-May policy meeting. Dow Industrials right now at the highs of the morning, up 191. Take a look at interest rates. The 10-year Treasury right now pulling back by about 2.5 basis points, sitting at a level of 4.60%. The Federal Reserve, of course, left interest rates unchanged for a sixth straight meeting, acknowledging, however, a quote of lack of progress in getting inflation back down to the central bank's 2% target. Here's the chairman, Jay Powell, trying to put to rest talks of a possible rate hike this year instead. Watch.
We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. It is likely that gaining such greater confidence will take longer. I think it's unlikely that the next policy rate move will be a hike. We'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time.
Mark, your reaction?
So, I think what we're seeing firsthand is the emotional volatility of investors. Because yesterday, here's what I heard yesterday coming out of Jay Powell. We don't intend on hiking, but we're sure as heck not going to cut. We're going to stay the course, more of the same. And I think investors initially were like, oh my God, it's great. He's not going to hike. Market zooms up and then immediately crashes thereafter and actually goes below the level at which it was when he started talking. But, when it comes to cutting rates, the market, investors obviously are addicted to low rates and they want low rates. And that's, I think, hope for low rates is what really has propelled the market this year. But we came into this year expecting almost 6 cuts, down to 1.4 if you look at the Fed fund futures market right now. And if you specifically look at the underperformance of small caps versus large caps, which would be those profitless companies, because over 40% of the Russell 2000 makes no money, that would cause you to believe that it's very unlikely that we do see any rate cuts.
Yeah, I mean, and you said that from day one, that you were not buying the idea that it was going to be 6, nor was I. Jason, you've got a great in-house development that you've done as strategist. You've developed what you're calling the strategist common man CPI of items that people must buy. It includes food, energy, shelter, clothing, utilities, and insurance. And this chart shows that American standard of living has deteriorated by 8% since President Biden was inaugurated. Tell us more about that.
Yeah, so as you know, the Bureau of Labor Statistics publishes CPI, and they publish something called core CPI, which excludes food and energy, which, of course, for the average person is ironic because food and energy is eating and staying warm is pretty core.
These are the essentials.
Right. So what we did is we went the other way, and we said, what are all the things that people must buy? Become hell or high water. So it's food, energy, clothing, shelter, utilities, insurance, as we pointed out. That has grown at a rate 8% faster over the last 3 years than wages. And this is part of the reason why I think the Biden administration sometimes wonders. They say, gee, why are we getting more credit on the economy? The unemployment rate's relatively low. The stock market is quite high. This is why people are feeling poorer. They have become poorer. And it's the cumulative effect of inflation that people are responding to.
Why do you think that is? I mean, 11 rate hikes, and yet we still have inflation sticky after these a couple of years.
The single biggest reason is that we're running budget deficits of $2 trillion a year. We're running a budget deficit right now of 7% of GDP. We've only done that 3 other times in the post-war period. And in every time we did that, the unemployment rate was above 7.
I see.
We're running budget deficits of a magnitude that are consistent with already being in a recession where we don't have to. We're doing that for political reasons, in my opinion, and that is why you're seeing inflation. There's no coordination between fiscal policy and monetary policy in the United States. Right?
Yeah, and even as the Fed, has instituted these 11 rate hikes, it's dealing with a tsunami of spending.
Absolutely.
Let's face it, the Democrats, $7 trillion in spending and borrowing on Joe Biden's watch. So that's why you say the biggest risk to the market is the prospect of higher bond yields.
Yeah, I think, listen, it's not just inflation may be coming down, but what's happening is we have increased the amount of debt on the country's balance sheet to about $35 trillion. Amazingly, Secretary Yellen is issuing short-term debt to fund that. 35% of it matures in the next year. Interest expense,
which is totally political, in my view.
Of course, there's no good reason for it because short-term interest rates are higher than long-term interest rates. Yeah. So you're taking more risk, you're spending more money, and I'd also say at this stage of the game, just the supply alone of treasuries is going to make interest rates higher. By the end of this year, interest expense will be higher than our defense budget. It'll be over $1 trillion. And that is not sustainable, and it's something that you can't control everything. And as the administration's finding out, you can't control interest rates, inflation, and the currency all at the same time. Yeah. And right now, this is being evidenced in higher inflation for longer.
Rebecca, I want to get to Apple and earnings, but let me just say that Biden is dispatching Yellen to a swing state and a forum named after John McCain to give a political speech. So she is just as political as the rest of them in this administration. She's going to say things like democracy has come under threat. That challenge was especially terrifying on the notorious day of January 6th. This is going to be in the Treasury Secretary's speech when she gives that political.
If I could just say, in my opinion, Janet Yellen is in the process of torching her reputation as an economist.
Yeah.
As the chairman of the Fed, that's seen as largely an apolitical organization. I think she did a fine job as Fed chair, and now she's revealing herself to be a political hack.
Yeah.
And it's sad, but it's also dangerous for the country,
yeah.
in my opinion. She has one client right now, who's Joe Biden, not the American people.
How sad. And we got these, the embargoed speech from Axios got some points in it. And she's also going to say undercutting democracy undercuts the foundation of sustainable and inclusive growth. She's going to try to tie in the economy somehow. She is, after all, the Treasury Secretary. Real political there. All right, earnings, another factor in markets this morning. Apple is reporting after the bell. I would say this is one of the most important reports that we have to talk about, Rebecca. What are you expecting? How do you want to allocate capital here? The stock is up 1.1% going into the numbers tonight.
Yeah, well, they're down overall year to date 11.5%, and it's all about China, Maria. They used to be the number 2 phone in China, and then they had all the consternation over the government saying no one can have an iPhone, so that brought them down to 4. And it's the same story that we're hearing with Tesla and Starbucks in China. After post-COVID in China, the economy has not rebounded, and obviously they've lost $7 trillion of market cap this year because of their real estate crisis. So it's all eyes on China. And we did get revised guidance in February down about 15%. So we are expecting it to be down, from last quarter. But this is really going to be a tell. Is China still the runway that Apple needs it to be? And I think the answer for now is no, especially in this political climate.
By the way, that was the pivot for this market when China came out and tried to ban the iPhone, or said they were banning the iPhone for government employees. Look at this chart on Apple, Mark. I mean, this stock has really been indicative
pressure
of what's going on in the markets in the second quarter.
Yeah, I mean, look, in my opinion, iPhone demand is waning. I mean, the phones become more and more expensive. People don't need to upgrade every single year. Okay. But then you look at, they kind of went all in on this $3,500 headset, which, in my opinion, if I catch you wearing it, we can't be friends, first and foremost. But $3,500, like they just slashed their expected shipments in half. Nobody wants it. I mean, you look foolish, and it's $3,500 that people don't have.
Okay, that's good.
And their AI spending is way lower than Google and Meta, so it's going to be interesting to see what their long-term play is.
Yeah, we'll see how they could put AI in there sometime.
Without the headset.
Reminiscent of the dot-com days.
Absolutely.
So true.
Guys, great conversation. Thank you so much. Jason Trennert, Mark, and Rebecca, you're with us all morning long, and we appreciate that. Thank you. Quick break, and then how the nationwide campus protests are impacting Florida schools.